Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. Great to have your company this Friday afternoon. I'm Juliette Sarli. Let's have a look at where the local market is finishing the day's session. Pretty good outcome there, up 0.5%. And I should note that the ASX 200 is also at 0.5%. And look, back above 8,900 points for those that love a psychological level. Over the last 5 days, the index has gained 2.2%. Great to be in a resource-heavy market like ours when you are seeing this, what many are calling commodity super cycle, continuing to see so much upside in all of these commodity players, even though global oil prices were down 4% overnight, ending that 5-day streak of gains, with President Trump saying the crackdown on protesters in Iran is easing, allaying these concerns over potential military action against Iran. We also had this big move coming through in tech players led by TSMC after it blew the lights out with its results. And of course, we've heard this agreement between the US and Taiwan, which is boosting tech stocks as well, particularly over in Asia. South Korea, very much a bellwether for AI. It's at a record, and the MSCI Asia Pacific Index also up by 1% to a fresh record high. Of course, the themes of the day really were this weekly win, and I mentioned the commodity supercycle. We can't forget Dr. Copper as well, and what that's telling us about the overall global demand for this commodity, particularly, speaking of AI, as it is being used to fuel demand for these data centers, and crude drop with that 4% drop coming through in oil. Let's see how it worked in terms of some of the stock specifics. Kicking it off with some of the banks today. They had a better session, a bit of profit taking from some of their miners, which saw a rotation, if you will, into some of these banks that were hit hard earlier in the week. Combank there, up 0.8%, $154.59. Still trying to hold on to its mantle as the most valuable stock on the ASX, because BHP has been trying to take that away this week. Let's have a look at tech stocks as well. WiseTech Global up 0.7%, Xero up by about 1.1%, and NextDC firmer by 3.6%. And when it comes to those energy players, the crude oil slump weighing on some of these energy players, particularly Karoon, down 3.3%. Now, James Hardie is going to close 2 of its US plants in a bid to save around $25 million in costs. It seems like the market liked that. Shares up by 2.6%. Speaking of copper and some record production that we saw coming through from Capstone, that saw its share price rise by around 7%. COB also in focus. It says its exclusivity period with Macquarie Asset Management is continuing. Shares up 0.7%. And a lot of focus in defence. Now, DroneShield was a top performer today, winning a government contract, and Hyperion X also receiving its final funding of $4.6 million from the US Department of War. Still getting used to saying that. Shares there up by almost 3%, and Austral there up by 20%, signing an agreement with Glencore to acquire the Lady Loretta mining leases in Queensland. All right, let's welcome to the COB Shane Oliver from AMP. Great to see you there, Shane. It's been a while. Hope you had a great break. We've missed seeing you on our screens. I loved reading your note today. Not quite the quiet year or start to the year we were hoping, thanks to our one US president.
That's right, Juliet. It's, you sort of hope that it's going to be quiet. There hasn't been a lot of economic data, although there's been quite a bit. But Trump's sort of certainly been out there almost as the year started. He was launching attacks on Nigeria, then Venezuela, obviously issues around Iran, which may still flare up again, Greenland, and then of course we've got this almost daily announcement of some sort of measure to improve affordability in the US. All of those things obviously have created a bit of noise. Interestingly, though, share markets seem to have taken it in their stride. I know the US share market's down fractionally, but not dramatically. Other markets are actually up. In Europe and Japan, they've made record highs. And our market so far this week is up around 2%, just over 2%. So it seems as if markets are saying, well, we've got all these things going on. Obviously, from an economic point of view, the most significant is the attack on the Fed. But there's an assumption that, well, maybe Trump will back down, Taco prevails, Trump always chickens out, or his bite is worse than his bark, his bark rather is worse than his bite. So all of those things I think are assumed by investors to sort of, tone it down a little bit, even though the noise is high. So consequently, you've seen reasonably good returns. And locally, you almost get the impression the local market in Australia is sort of playing catch up after years of underperforming the US. I suspect investors are thinking, well, we're going to see these stronger profits coming out of the miners. Australia has a lot of miners, the US doesn't have as many, and that hopefully should see our market maybe become an outperformer relative to the US this year. But obviously a long way to go. But I guess the good news is that markets have so far been reasonably resilient. But it is interesting to note that even though you might say that, there is that demand for gold, which is kicking in there. So when you look at that, the share market chart there, you can see strength. When you look at gold and silver, they've gone through the roof. Obviously, you get these pullbacks every so often, silver and gold in the last 24 hours, but they are around record highs. And investors, I think, are saying, well, we like the global investment environment. Interest rates still low. Some central banks may still cut rates. Profits are improving. Economic growth looks okay. So that's good for shares. But by the same token, we've got these geopolitical threats. We've got the threat to the Fed from Trump, who I don't think has any clue what central bank independence means and why it was ever adopted. And therefore, we want to take out a bit of protection against that. So that's why they're buying gold and silver as a hedge. So I don't think it's inconsistent. I think it just reflects investors playing a little bit cautiously and thinking, well, if we buy these assets, it'll provide us some protection should US inflation really take off again in response to a Fed which gets dominated by Trump.
All right, let's time code it. January 16, 4 p.m. Sydney. Shane Oliver calling the Australian market to outperform potentially some of the global peers in 2026. But when you look at that chart, fingers crossed, when you look at that chart and you see how heavily resourced we are to, exposed, I should say, leveraged to these commodity players, I mean, it makes sense, doesn't it? Let's get to the other factor on everyone's minds, what the RBA is going to do. A fair bit of data has been out in terms of consumer spending, household spending, consumer sentiment, inflation. AMP, though, I believe you still think on hold this year, is that right?
Yeah, that's our view, on hold. I must admit, last year I look back and I think, well, this time a year ago we were saying there'd be 3 cuts. We got the 3 cuts, but then of course we thought there'd be 2 or 3 more by the time we got to August. And that, in fact, was the market expectation. You can see in that chart there that back in August, which was peak rate cut optimism. Since then, you've seen a big turnaround, and we're a bit slow in picking up on that turnaround, and particularly given the upswing in inflation. But we still think it's too early to start talking about rate hikes. And it is worth noting that in the last month or so, there has been some downgrading in market expectations of hikes. We did get those slightly lower than expected inflation numbers out a week ago. That's certainly helping. And the economic data, I think, has been fairly mixed. Yes, we've seen stronger building approvals and strong household spending data out earlier this week. But on the flip side, consumer confidence still remains fairly depressed, particularly on the ANZ Roy Morgan measure, as opposed to the Westpac measure. But even if you take an average of them, you're going to get a low number. And then, of course, job ads. When you look at the ANZ Indeed job ad series, it also looks pretty soft. So I think against that background, assuming that the December quarter inflation numbers are sort of reasonably well behaved when they come out at the end of this month, then I think the Reserve Bank will leave rates on hold. But obviously it's a close call. There's lots of economists out there who I respect who are looking for hikes, if not in February, then through this year. But I think it's just a bit premature to do that. And if you do that, I think you'll snuff out the recovery. You can see that in consumer sentiment numbers. It was rising nicely, and then suddenly we start talking about rate hikes, and consumer sentiment has fallen for 2 months in a row. So I think that's telling us that there is a bit of sensitivity out there, and premature rate hikes, I think, would see the recovery, the upswing in growth snuffed out. So on hold is our view, although I would concede it's a close call and the risks are on the upside.
Yeah, no surprise. Those consumer sentiment surveys showing our mood souring with all this talk of rate hikes potentially. What are we watching over the next week, Shane?
Well, it's there's still delayed data coming out in the US. On Thursday, I think it is, we get the private final consumption deflator numbers, and the core PCE will be the one to look at. This will be for November, though. It's yet to catch up to December. We've got the December CPI, but we're still getting the November PCE data. That'll probably show inflation in the US running at 2.8%. That's the Fed's preferred measure. I don't think that's going to change the the Federal Reserve's thinking either way. It will leave the Fed on hold for this month. We also got PMIs coming out for Australia and other countries on Friday. I like to look at them because they're a good guide as to how business confidence and business conditions are going. So far, so good. They've been around levels consistent with global growth around 3% and Australian growth around 2%. And then, of course, in Australia, we've also got jobs data on Thursday, which I regard as a highly unreliable series from month to month. It bounces around all over the place. We have had several weak months in terms of employment numbers. This month for December, I think we'll probably see a bit of a bounce. We're looking for a 30,000 rise in employment, but unemployment will probably also go up because there'll be more participation. And so you'll probably see unemployment going up a little bit, which I think in terms of the way the Reserve Bank looks at it, we'll just see things remain unchanged in their view. In other words, unemployment is still relatively low in their view of things. And even though it might be going up in an uptrend, I don't think that will change their view regarding their characterisation of the labour market, which is slightly tight or something to that effect. So, yes, we do have that. We also got the start-up of the US profit reporting season in the US. And, of course, these are always looked at quite closely. And for the last year or two, the numbers start out as, I think this quarter, December quarter, expectation is 8.7% profit growth on a year ago. Will probably end up being around 12% or something like that. So I think it's still going to end up being a reasonably good profit reporting season, which of course underpins further gains in the US share market. But as I mentioned earlier, I think there are some arguments to be made that maybe the Aussie share market might start to do a bit better this year in a relative sense, because the profit drivers might start to change. Somewhat slower growth over time coming out of tech, somewhat stronger growth coming out of miners, and of course our market is more exposed to the latter, and that hopefully might see our market start to outperform a little bit as we go through this year.
All right, Shane, I know you've been on holidays. You've got a very, very impressive bookshelf behind you. What did you get up to? What did you read, listen to, think about?
Well, it's funny. I was just had this on there next to me. Maybe I was thinking that you might ask about this, but
Jane Birkin.
I've long been a fan of Jane Birkin, and I think I discovered her. I don't know. She came out to Australia actually in 2012. She would have been at 65 at the time, and I only read about it after she'd come and gone. I would have loved to have gone to see her. I love the story with Serge Gainsbourg, or however you pronounce that, back in the late 60s, around the time that French film called Slogan was released. I love the Birkin bag story. She gets on a plane, her bag's falling apart after her third partner, Jacques Deloigne, ran over it, I think. And then she's sitting next to the head of Hermès at the time. Hopefully I pronounced that correctly, the French fashion company, and they then design a new version. I think this is 1983. They then design a new version, and she becomes synonymous with the Birkin bag. But she's got an amazing story, and it's good to see that someone's finally written a biography of her. So I found that a really fascinating read. But having read that one, I've gone back to reading fantasy novels. Brandon, his name's fantasy novels like Tolkien sort of stuff. So that's usually my favourite stuff to forget about investment markets when you're trying to go to bed at night. But usually I prefer to read non-fiction. I'm not someone who sort of ends up reading a lot of books on economics or business. I like to skim through them, but the books I really love to read are either biographies, like the Jane Birkin one, or fantasy novels.
You are such a wealth of information. Who would know you know the origination story of the Birkin bag, which I was just reading retails from US $10,500 to $2 million per bag. So I'm going to put it out there that I may never see a Birkin bag on my hand in my life. Shane Oliver, great.
I think the Genesis Birkin bag, the one that was first made for Jane, of course, she ran it into the ground. But anyway, it was sold at auction, I think, for more than $2 million from memory.
Wow.
So yeah, they do fetch a lot of money. Obviously, if you want to get a Birkin bag up front, you're going to pay several thousand for one, maybe 10,000s. I don't know what the precise number is. I haven't tried to buy a Birkin bag. But they do tend to become collectible items, particularly the ones that Jane Birkin actually had.
All right, Shane, great to chat. See you again soon. Shane Oliver, Chief Economist of AMP. Getting back to the stock of the day, it was Wellnex Life. Nadine was joined on a small cap special with Luke Winchester from Merewether Capital, Dean Fergie from Sign Investment.
One, the company's pretty inexpensive. It's got a market cap of about 11 million bucks. They spent a fortune trying to list on the AIM last year, which they did successfully, thinking it would be the solution to all their problems, and it hasn't been. Just for me, there's a lot of kind of corporate governance communication red flags for the business. It hasn't been profitable to date, so it's one that I quite clearly don't look very favourably upon.
They've got a $2.3 million loan with a former CEO, and the word former is the key there, because he's now left the business and he's demanding to be paid back. So they've had to come to a payment plan with the former CEO for money that, quite frankly, they don't have, and I think it'd be quite difficult to get their hands on. I say this a lot when I come on to Dean, but for these sorts of businesses where you are a brand, you theoretically own IP, the first thing I look at is gross margins. And you highlighted it in the intro. It's gone from 23% to 30%. That's good. That's the direction you want to see it go, but 30% is far too low.
Let's have a look at the leaders and laggards in today's session. Catalyst Metals, we've discussed here this record production output. DroneShield won a government contract. Capstone Copper, of course, on its production update. DPLO had a broker upgrade. Treasury Wine Estate getting a little bit of love after being sold off on some broker downgrades earlier in the week. To the downside today, a fair bit of lithium loss after a fair bit of lithium love of late. PLS and IGO lower. Karoon Energy, as we saw oil fall by 4%. Minres and Neuron Pharmaceuticals also lower today. In the small end of town, these companies had a good day, including Bougainville Copper. We touched on Austral Resources as well on that deal, up by 20%, and Monica Resources up 12%. To the downside, in the small end of town, Novonix was off 15.4%. and Gallon Lithium down by 7.7%. Tonight, Bank of England Governor Bailey will speak, and we also have US NAHB Housing Market Index due for January, sentiment there at an 8-month high. Looking at the US earnings, we've got Regions Financial, M&T Bank, PNC Financial Services, State Street as well. Next week, gosh, Davos time already. World Economic Forum in Switzerland, Donald Trump due to speak there. Thursday, we get the jobs number, of course, Shane just saying. And another economist told me very early in my career that series is basically like getting out a dartboard and throwing a dart at it. And the BOJ decision from the Bank of Japan on Friday. Let's have a look at where the local market is finished, up by 0.5%. The ASX 200 had a similar gain. It is up by 0.5%, 42 points, 8,903. For those that like technicals, back above 8,900 points. And over the week, we're up by about 2%. Really just a dip in energy today and a switch out of some of those miners that have performed well. But I think we would call that a very good week indeed, up 2.1% on the week and just over 2% from all-time highs. Have a very safe and happy weekend. Maybe you're doing some reading like Shane Oliver. We'll catch you on Monday from 9:45 a.m. Eastern.